Hello everyone, it is Evan here from the Trade Risk, and I've got sort of a new little format I'm experimenting with. I received a very interesting comment on one of my videos, and I thought it was worth sort of taking the time to educate and sort of talk through maybe the perspective of this trader, and hopefully this is something informative and educational for more than just replying to this comment directly. And that's why I decided to fire up this video. It's a different format. I'm sort of going to off the cuff go through some different tabs I have open and some different charts I'm going to show and just kind of bring it into view, talk about it, and sort of walk through this. So let me know if you like this format, because again, it's something new, and if it's helpful, leave a comment below. And I'd also love to hear your thoughts and perhaps feedback for this trader, for this comment, and see if you can kind of help educate this person. So here's what we got. So I received a comment on this video here. So this is a how to get started swing trading stocks. This is an oldie that we did back in early 2017. It's pretty popular. It's got almost 100,000 views on it at the time of recording, and it still seems to bring a lot of attention and lots of comments on here on this video. So one that just came through the other day, the comment reads, 20% a year is a waste of time. Many stocks give you 100% or more a year of passive income. Swing trading made right can make you a lot more. Now, a couple of things. First is I'm going to assume that the intentions here, or I'm going to just read, I'm interpreting this comment at face value. So if it's a troll and is having some fun, then so be it. But I do think that this comment raises just lots of interesting and kind of complex conversations, topics actually. And I'm sort of reading this as someone, as a trader that is perhaps just new to trading. So as a trader that perhaps has only been trading for 6 months, 12 months, maybe 18 months, hasn't seen a whole lot of market history, has seen markets perform unbelievably strong in the past year or two. And, in the face of a pandemic that closed down much of the world, stocks just continued to rip higher. I think if I were in if I were in those shoes of only trading in this limited amount of time, I'd probably have a very similar sort of worldview that 20% a year is a waste of time. I can go buy Tesla stock and make 500% in a single year. Why am I going to bother swing trading, right? So that's the perspective that I'm sort of taking when I'm going through this comment here. So again, I'd love to hear some of your thoughts to this. So there's a lot here, and these are big topics actually. So we're only going to kind of scratch the surface, but I want to take this kind of one line at a time. So let's start with the 20% a year being a waste of time. So first, let's talk about 20% a year. To know if that's a waste of time, first, we need to understand what's normal. What does the stock market hand out as its sort of risk premium for owning stocks? And so I can open up this chart here, or this site, macrotrends.net. They have a 100-year historical chart of the Dow Jones going back 100 years. They have all the returns listed below. In fact, actually, I can pull up the S&P 500. See if I can get this up here. Quarter over quarter, looking at TC 2000. So this goes back to the 60s anyway for the S&P 500. And we can draw a line from the very, very start all the way over here to all the way up to where we currently are. And it's 58 years of time in this particular chart. And the annualized return is 7.33%. So that's starting in the 60s. If you go back to longer period time, like the 100-year Dow chart, you're going to arrive at a number that is in the upper nines. Let's call it 10% on average gross annualized return over a very long stretch of time for owning the Dow or the S&P 500. We're going to round to 10%. It's not exact. And that doesn't include, inflation and all that. These are gross returns. So 10%, that is what you collect as an investor for owning at, virtually no cost or little cost for owning the S&P 500. Okay. So that doesn't include any taxes and all that other, math that comes in afterwards. So, so 10%, that is our benchmark for owning equities. Now, when we say that 20% a year is a waste of time, we have to first then say, okay, well, if you're actively trying to trade the market, you need to first beat the average. And we know, right, if we look at CNBC here, this is time after time again, there's hundreds and hundreds of articles I could have chosen. Active fund managers trail the S&P 500 for the 9th year in a row, right? Triumph for indexing. We can look at this article here from Market Watch. This is an older one titled "Almost No One Can Beat the Market." Now, obviously, we are in the business, the trade risk of, basically building systems to beat the market, either from a return perspective or at least risk-adjusted returns is how we always like to phrase it. So it's possible, of course, but it is hard, right? And that is a fact, is that most professionals underperform the market. Most retail traders lose money, break even, or cannot beat the market. So when we think about a trader that can earn 20% per year, which is double the market, we already know that that person is in a very, very slim minority, right? Because we know that the data suggests that not everybody can be winners, and it's very hard to beat those averages. So with that kind of in light now, where we know that a 20% year return is a very hard thing to achieve, you then have to ask about this time concept. Is it a waste of time? This is actually something where I would potentially agree with this comment, is that for a lot of traders, it can be a waste of time. I wrote this article here on how to maximize your screen time adjusted returns. It's a concept I feel pretty strongly about, and I should probably write more about it and in some different ways. This might be too high level of a title to sort of understand what's going on here. But this article is all about the time spent to achieve returns, the time spent to trade the stock market, and sort of asking yourself, is your time spent worth it, right? Because if you're scratching and trading 40 hours a week of looking at markets and watching while Wall Street's open, and then you're journaling another 10 hours, and then you're researching another 15 hours, and you're reading books another 5 hours, you're all in spending 60, 70 hours a week. That's a lot of time, right? And so this is a big topic. It's all personal, obviously. I think the way to sort of illustrate it here in an easy way is that if you have a $10,000 trading account and your goal is to earn a living trading, and you're earning 20% a year, you're spending 50 hours a week, that is a waste of time, right? Objectively, if you have $10,000, you're earning 20% a year, you're spending all this time, there is an infinite list of jobs, entry-level jobs, that would earn you a tremendous amount more money than your $2,000 per annum on 10K, right? However, if you have a $3 million trading account and you can earn 20% a year from actively trading versus a 10% return from the market, and you have to deal with all the market drawdown and natural volatility, then it becomes a lot more worthwhile, right? So it's an interesting concept. We're not going to sort of be able to solve it here, but I do think time is actually something that we should all think about in terms of how much time we're actually spending. Could we, do other things with that time, optimize our trading, spend less time trading, et cetera, et cetera. Check out this article if you want to hear more about that. So I think that kind of covers the 20% and waste of time component. Let's go to the next part of this comment here, which is many stocks give you 100% or more a year in passive income. So that is a pretty bold statement, and I think it's a bit naive of a statement. So let's try and illustrate here where this person may have gone wrong. This year was a fantastic year for the market, right? It started off horrible, but then it ended up turning out to be a very strong year. So we've got the NASDAQ that's up, I don't know, 40% or more this year. And so lots of stocks have done really well. Now, if we take a look, though, at this watch list here. So this is the S&P 500. I'm looking at TC 2000. So this is the S&P 500, all 500, looks like 505 components right now, stocks inside of the S&P 500. And I have this column here, the 12-month return. I'm recording this December 29th. It's looking at 12 months of data, or full 1 year. So it's looking a little bit back in 2019 by just a few days. So these numbers aren't going to be exactly precise, but they're sorted in terms of strongest return. So Tesla is at the top of the list, a 701% return. That is bonkers, but that is the top of the list. You can see actually that there's only 6 stocks that had 100% return or more this year. That's still a big number, or a pretty, and there's lots of stocks at 92. So anyway, 6 stocks out of 500 were 100% returns. So you had to be able to pick those 6 stocks ahead of time. So you had basically what, a 98%, 99% chance of picking the wrong stock that was not going to be up 100% this year. Furthermore, let's scroll down this sorted list. And when we get to number, let's see right here, number 294, you can see on the 294th stock, the return this year is negative. So that means that not only did you only have a 1% chance of picking 100% winner, you also had basically a 40% chance of picking a loser on the year. So forget about even earning your 10% return per annum average. You actually pick something that lost money, right? And you could scroll down this list and you could have lost as much as 50 or more percent if you pick the wrong stock. So many stocks giving you 100% a year or more in passive income is a very sort of misinformed, naive statement. Again, I don't mean that in a mean way or derogatory way. It's just kind of the facts here that we're looking at. And this is all made to sort of educate in the best best positive way possible. If we look at Value Walk here, 80% of stocks have a lifetime return of 0. So this is a study they did basically showing that most stocks, in fact, not only just underperform, but they basically go to 0, they delist, they get taken private, et cetera, et cetera. So again, stock picking and passively holding, 100% or more winners is extremely hard and extremely unlikely that you're going to be able to do that consistently. The last part of this comment I want to touch on here, swing trading made right can make you a lot more. It can, but here's the thing. Now, swing trading made right makes you a lot more than 100%. So if most stocks, if the comment's implying most stocks can make 100% or more per year in passive income, swing trading can make you a lot more than that. That's a pretty tall order. So let's talk about that. Can you make more than 100% swing trading in one single year? Yes, you obviously can. You can use leverage, you can use options, you can use futures, and you can achieve that. You can also be a great stock picker and great market timer, and with no leverage or options, you could theoretically produce more than 100% per year. It's possible. Is it something that you can consistently do or bet on? I would say no. And I would say no pretty firmly and confidently that is not something you will be able to repeat consistently over and over again. You would very quickly become the richest person in the world if you could just do that endlessly. If you use options, and there are plenty of options traders that post, hundreds % return per year, you have to take into account a couple of things. First is there's tremendous leverage there. The second thing is there's this notion of, we have this page up on the site, so trading system performance metrics. So we have things like CAGR, which is compound annual growth rate, but then we have things like maximum drawdown, Sharpe ratio. These are equations and ways to sort of measure your trading performance, your equity curve, and put it in terms of risk-adjusted returns, right? How much risk are you taking? Most options traders that can do, 500% a year, they can very likely blow up that same account, right? That whole account could go to zero, just as much as it could go up 500 or 5x. The way they can operate like that is by only investing small amounts of their money in that overall account, right? You can imagine if you had a $10 million account, you're probably not going to be, sticking that entire account into, weekly options or, some crazy just option strategy that has that type of volatility, right? Because if you can make 500% a year, you will have a 90% drawdown at some point, right? That's just the name of the game, or go bust. And so the risk of ruin is potentially high in those types of strategies. Same thing when you start to use lots of leverage in an undisciplined sort of manner. So I would be very cautious on this last comment, or this last part. Swing trading made right can make you a lot more. It can. It's hard, and it's hard to do it consistently. So to say that off the cuff is something that I think warrants, a little bit of a pause. So that's it. I think that kind of covered all of the parts here to this comment. Again, hopefully this is informative. It's kind of fun to go through this and just do it a little more loosely. What are your thoughts? I'd love to hear them below. And also, do you like the format? Because I would potentially do more of these, and they don't have to be based on someone's comment. It could just be other sort of off the top of my head kind of topics where we go through some tabs and pull up some charts and just sort of do it in this informal way. So leave a comment below. Do you like this video? And what are your thoughts about this comment here with landlord? Again, we're going to keep the intentions pure that this comment's not a troll and that it is someone that is needs to be sort of educated and caught up before they blow up their account or something worse happens. So that's it for me. Thanks as always for tuning in and watching.